part of a series that the Center for Social Justice and Socialist Project have been doing. We've been doing ones on Aboriginal solidarity, which had very good attendance. And also another one on migrant workers over the summer. And we're also working on ones on the Palestinian economy to put on sometime in the winter, and also on the housing crisis, on different dimensions of the contemporary political economy of capitalism. The one on the Palestinian economy, I mentioning it, I have to congratulate Adam, Hanieh, and Rafif Messon, and the other activists in CAIA for an incredible opening last night for the Toronto International Festival of Palestinian Cinema. I didn't get quite the name right, but it was an incredible sold-out house. It was an amazing, emotionally great event. It was really fantastic. The speakers today to kick off are Adam Hanieh, who's an activist in CAIA, also at political science or labor studies and political science at McMaster, and Tom Marois, who's active in labor, Latin American solidarity work, and also teaching development studies at Queen's. They'll kick off the first workshop on Marxian views of financial capital and credit, and I'm Greg Elbow, and I will kick off the second one on capitalism, neoliberalism, and the current crisis, about kind of the dimensions of the current crisis. Then we'll come back and discuss at the final one the different debates about alternatives, partly what the state and states around the world are doing, and then also looking at what are the debates putting up forward on the left. Now, the one caution we always have, I do a lot of workshops on for different kinds of groups on economics and political economy, and one never knows the level of the audience. We're already doing something different, and there's more people here than I usually get for those ones, where you get about 5 or 6 people who want to learn about interest rates or something. So we're already doing better. So we'll try to do it. We'll try to do it relatively intro, and then expand to more complicated issues as we go along. And the discussion can be both about political issues related to what's related, and also issues of clarification. So we'll use a kind of interactive form of presentation and discussion. So I think Adam is going to kick it off. So I'll turn it over to Adam.
Okay. Thank you, Greg. And I want to start by saying I think we are living at a very important period in world history. I think that what we are seeing happening, unfolding in these last few months, really we'll look back on it as some kind of turning point, as something that really affected how the rest of history will turn out. It's a time, I think, when there are going to be a lot of breaking of illusions in the system, and a lot of people looking for some kind of alternative. So I think, you know, the turnouts that we've seen today, as well as over the last few, there have been other forums and meetings such as this where very large turnouts. I think that's some kind of indication. The depth of this crisis is clearly terrifying to many mainstream economists and politicians as well. Every day we hear directors of the IMF and politicians talk about things such as systemic meltdown, cliff diving, which is a term which I'd never heard before, but is used to describe like plummeting stock markets. Peering into the abyss is another one that many people talk about. And these are from people who are not normally prone to exaggerated language. They're normally very reserved in how they describe things. And even Alan Greenspan, the person they used to call the master of the universe, is now saying that there is a flaw in the free market system. So in that respect, I think it is very much a turning point that we will need to understand, and we will look back on, I think, as much as that critical point in history. But it's also clear that many of the people that you read in the newspapers, you see on the financial news, etc., really don't have any idea about what is going on. They can't explain it. And that is why I think this kind of meeting today is so important, because really I don't think it can be we can understand what is going on in the world economy and this crisis without a Marxist framework. So I think that's what hopefully we can nut out some of those issues today. Just looking at what I want to outline 4 basic explanations that the mainstream press, the mainstream economists the way they present this crisis. The first one, we often hear, or we hear a lot of people talking that this is a problem of a lack of regulation around housing loans. Okay, we hear that banks in the US gave out these subprime mortgages. These were given out on very easy terms. Basically, people who had no jobs, no income, so-called ninja loans, no income, no jobs, no assets loans, ninja loans, are identified as being part of the problem. And when people couldn't pay them back, banks started to collapse. This is one explanation that you hear in the media. The second explanation is an argument that blames hedge funds and speculators or greedy bankers. This is something else that you hear a lot in the last few days, where they look at these speculators and say these people borrowed a lot of money. They speculated them through derivatives and hedge funds based on a lot of debt, and this system is basically collapsing because these people gambled away or were gambling. And this is, if you follow the debate around the bailout bill, a lot of the politicians arguing around the bailout bill said that the blame for this has to be laid at the feet of these hedge funds and financial speculators. The third explanation that we hear a lot of these days is that this was the mistakes of Alan Greenspan. Even Alan Greenspan himself has said that in the last few days that he made some mistakes, and that it was during the 1990s that basically that there was easy money to be had because of the low interest rates through the 1990s, and that the regulators were asleep at the wheel is another turn of phrase that people are using, and that because of these reckless lending policies, the people were allowed to engage in these derivatives and speculation, and that's the cause of the crisis. Nouriel Roubini, who is one of the most prominent commentators you hear in the financial media, has actually been predicting a collapse of this sort for a number of years. This is his explanation, that it was the regulators asleep at the wheel, easy money to be had, and Alan Greenspan is basically to blame. And finally, the fourth explanation, which we hear sometimes on the left liberal spectrum, is that this crisis is something that capitalism has manufactured, and basically the capitalist class is going to use it to kind of attack working people, and that's the reason. That's the reason that this is happening. So, at one level, these four explanations do contain some element of truth. It's very true that the spread of the subprime mortgages and the bursting of the housing bubble was a key element in the crisis, in the current trigger in the current phase of the crisis. It's true that speculation on derivatives, and we're going to talk, Tom in particular is going to talk about some of what these derivatives actually mean, did lead to massive debt levels, and banks and hedge funds are now going bust on the bets that they made around interest rates, etc. It is also true that much of this leveraging and debt build-up was made possible by lack of regulation and low interest rates. And it also is true that the capitalist class is going to use this to attack working people and offload the crisis, or attempt to offload the crisis onto working people. But the problem with these four explanations is they actually don't explain anything. They just describe what is happening in the system. They don't explain why the system is unraveling in this way. It doesn't explain, for example, why does capitalism have crises? Why did the credit bubble actually appear in the first place? And why is capitalism full of these bubbles that appear and then burst? Why did these financial instruments, such as derivatives, suddenly appear on the scene? In other words, if you don't believe that this crisis is caused by just policy mistakes, then in order to understand what is going on, you need to have a theory of how the system functions. So that's kind of what I want to do in my section of the workshop, to give a sense of how we can understand how the system functions, and also a bit of a sense of history of how we got here, because that's something that you really don't get in the mainstream explanations. Okay, so as I said earlier, I think the only way to really understand the crisis is through a Marxist framework. And I want to outline just a couple of things I think we need to keep in mind around this. The first thing is that capitalism is a system driven, it's a system of privately controlled production driven by the pursuit of profit. We say this a lot, and sometimes it may seem a bit self-evident, but really I think it's important to keep this in mind. Everything capitalists do is done with the idea that they want to accumulate more profit. It's the driving force of capitalism. This is the basic logic of the system, and you can't understand anything under capitalism without keeping this in mind. It's the accumulation of profit that drives the functioning of the system. If you understand that point, then many things that appear irrational on other measures, human measures, actually appear rational under capitalism. For example, you might think, often when you think about capitalism, you think, why the hell would they do something as stupid as that? It's just crazy. But under capitalism, it actually makes sense. For example, the idea that banks would approach thousands and thousands of people around the United States who don't have any job, who don't have any income, who don't have any assets, chase them, plead with them to borrow money, take the money that they lend to these people, cut them up into hundreds of different little loans, spread them around to other banks, and then speculate on these instruments, which is basically what these ninja loans is. And again, Tom is going to explain this stuff in a lot more detail. It sounds stupid. It is stupid. Clearly, at some point, this is going to collapse when people can't pay back their loans. But under capitalism, this is perfectly rational. It does actually make sense because, and in fact, you are compelled to do this as a capitalist. Because if you don't, and another bank or another company manages to make more profits than you do, to accumulate more capital than you do, then you are at risk of being swallowed up by your competitor. So this pursuit of profit and the competition around accumulation of profit really is at the heart of the system. And this is one thing to understand about all of the financial instruments we're going to be talking about today. They did not arise because speculators are evil people. They did not arise because of crazy bankers. They actually arose for specific reasons within the system. And it is perfectly rational in a system driven by the pursuit of profit for these kinds of instruments to arise. So we shouldn't go, blaming the greedy banker, which is what a lot of the Keynesian or left liberal approaches are taking, is not the right way to understand this current crisis. Okay. Given that the pursuit of profit is the prime force that drives capitalist behavior, the question that we need to understand is, where does profit come from? And to answer this question, this is really the nub of Marxism. To understand where does this profit come from? And to do this, we need to kind of step back from the complexity of the contemporary economy and look at the production of things, basic things that are bought and sold on the marketplace. What we call commodities, and which is where Marx began his analysis of political economy, with the commodity. What Marx said is that the profit that a capitalist makes when they sell a product doesn't come from exchange. It doesn't come from when they go to the market and actually sell it for money. It actually comes from the production process itself. It arises from the worker who is forced to labor to sell their ability to work to the capitalist. And in return for their labor power, they receive a payment for a certain amount of labor time that they give, and that's the wages that a worker receives. In the production process, the worker, not the capitalist, the worker, creates value that is over and above the value of the wages that they receive in payment for their work. Okay, so the worker goes to the capitalist, they sell their labour power, they say, I will work for you for 8 hours, 10 hours, 12 hours, however many hours a day. They work for that period of time, and they get compensation for that work, that amount of time that they work. But the value that they create during that hour, or those hours of work, is over and above those wages, over and above that compensation. Marx called this extra work, or this extra value, surplus value. And this is where profit comes from. It comes from the worker in the production process. It doesn't come from what happens later when the commodity is sold on the marketplace. It is realized when the commodity is sold. We say this profit or the surplus value is realized as money when it is sold in the marketplace. So I'm going to draw on the board one way of visualizing this process of value creation and it's a product being created with extra value and being sold on the marketplace. Something which, if you've come to Socialist Project talks before, this always gets drawn on the board. The circuit of capital. This is Tom is also going to talk about this in a lot more detail. But I think this is a very useful and critical way of actually understanding how does the production process work and where does the value that has come from. Here we have money. The capitalist starts with a certain amount of money. With that money, they purchase or commodity, some commodities. The commodities that they purchase for production is labour power. Okay, the ability of the worker to actually work for a certain amount of hours in a day, and means of production, meaning the factories, the raw materials, all of the input that goes into the production process. Okay, so the capitalist comes along, gets some workers to work for a certain amount of time using a certain amount of raw materials and instruments, machinery, combined all together in the process of production. At the end of the process of production, you have a new commodity come out, which we call C prime. This little dash means prime. We say C prime. A new commodity that has extra value, has surplus value on top of the value of this initial commodity. Okay, so this C prime has more value because of the labour power that has been expended in the production process. And then it comes to market where it is sold for M prime. And here M prime is a sum of money that is greater than the initial amount of money that the capitalist began with. Okay, so this M prime is bigger. Obviously a capitalist wouldn't go into this production process if they didn't want to make more money. Okay, the aim of this process is for M prime to exceed M, which is the profit. So again, this is something that we will refer to, and Tom is going to extend this a little bit in his talk. But the key thing to remember is that the value that is created, the extra value that is created only comes through this, only through labour power. Okay? This is really a critical point of Marxism, that it is labour power in the production process that creates value. It is not this part here, it's not the sale of the product on the marketplace. Okay, if we look at this circuit, there are five things or five tendencies that you can see that arise from this type of circuit, and I'm quickly going to go through these five tendencies. There are many other tendencies that you can see, but I think there are five things I want to highlight, which helps to understand what is going on. Obviously, this is a very abstract model. Real production is a lot more complicated. There are many circuits over many different countries, different industries, different sectors. They all interrelate and interconnect, but the basic circuit can be understood as this. So what are the five tendencies that I think are important to understand? One is, the first one is, if we see that it is this relation here, the relation between the worker and the capitalist, in the production process that creates value, then because the purpose of capitalist production is to create extra value, to accumulate value, then this relationship, the relationship between the worker and the capitalist, has to be expanded as much as possible. Okay, so there is a tendency under capitalism to expand what we call I'll call it the value relation. Okay, a tendency to expand the number of people that are engaged in this type of relationship and the different kinds of sectors. Okay, so what does this actually mean in reality? Number one, it means that capitalism tries to expand geographically. Okay, it tries to grow across the whole globe and swallow every human relationship within this value relation. Okay, it tries to make all production encompassed by this value relation. Okay, so we can see that today geographically with the expansion of capitalism across the globe. We can also see it through the process of commodification. Okay, things that normally, previously, were produced in the family or in kinship groups that wasn't part of this, wasn't a relationship between the worker and the capitalist, it gets produced capitalistically, gets produced in this value relation. So, for example, we see now that pollution is commodified. Okay, even something like pollution is commodified in this carbon trading, these kinds of carbon trading schemes. Okay, we see every kind of thing, every kind of production of anything turned into a commodity that's bought and sold and produced by the capitalist in this way. So that's one thing. The second thing is that because the capitalist's role is to make as much money as possible, accumulate as much capital as possible, they want this circuit to move as quickly as possible. Okay, they want to go from M to M prime as quickly as possible, because the slower it takes, the longer it means the less money that over time you are going to be accumulating. Okay, so Marx called this the turnover time of capital. The turnover time, and he said that the turnover time has a tendency to be shortened, okay, to happen as quickly as possible. Capitalists try and rush through this circuit as fast as possible. So we can see the implications of this today. For example, everyone walks around with blackberries or wires hanging out of their ear because this is the reason for this is this. One of the reasons is this turnover time, okay? Because they want this. They want the worker to be engaged in production all of the time. You don't want to have a break, okay? Because this has to happen as quickly as possible. The interconnection of people has to be as complete as possible. So this turnover time is a very important thing. Capitalists try and produce as quickly as possible, put it on the market as quickly as possible, sell their things as quickly as possible, and start the process again to maximize their production and their accumulation. Thirdly, and this is a very important thing to understand. Thirdly, because the value of a commodity is determined by the labour power that's put into it, Marx said that the value of a commodity is determined by the socially average labour time that is required to produce it. Okay, meaning that the amount of labour time that you put into making something, the average in that for that particular commodity is the value of that commodity. So, for example, if it takes 2 hours of labour on average to make this pen, that's the value of the pen. Okay. So, if a capitalist who is a pen maker produces this pen with 3 hours, whereas the social average is only 2 hours, they're wasting labour time. Okay. If this pen normally takes 2 hours to make, but a capitalist takes 3 hours, then they're wasting an hour of labour. But if there's another capitalist who produces the pen in 1 hour, then they're saving labour time. And Marx will say that the capitalist that produces it in 1 hour will take value from the less productive capitalist. Okay, so what this means is that capitalists try and be as productive as possible. Okay, they try and produce goods at as higher productivity as possible in order to take value from the less efficient producers. So there is always then a tendency under capitalism to improve the productivity of labour. Okay, to produce things with fewer workers and an increased amount of goods. Okay, what this means in practice is introduction of machinery is one way of doing this. Okay, to produce things with machinery rather than with a lot of human labour, to replace human labour with machinery. Okay, so if you think about it though, if human labour is the thing that creates value, and there is a tendency for productivity of labour to increase to more machinery rather than humans doing this work, you're going to see less value on average produced over time, okay? Because there's less human labour power going into the production of the commodities. Okay? It's a little bit complicated, this idea, but it is, I think, important to understand that over time there is a tendency under capitalism for less labour power and more machinery, okay, in the production process. And what this means is that there's a tendency for less value to be accumulated. Okay, so this is an important part of where finance and credit and stuff actually come from, and we'll come to this as we go on. Another tendency, which you can also see and everyone is familiar with, is the concentration and centralization of capital. Okay, this means that there are fewer and fewer capitalists that own more and more capital. Okay, there are monopolies, in other words, that develop. Okay, the amount of capital is controlled by fewer and fewer hands, and this is clearly something that's happened over the history of capitalism. Okay, because of competition, the smaller capitalists get swallowed up by the larger capitalists, and there's fewer and fewer hands in which capital is concentrated and centralized. Okay, you can see that in every industry today. For example, the beer market in the United States is controlled by two companies. Okay, they produce basically 80%, I think the figure is, of all of the beer in the United States. This is an example of concentration and centralization of capital. And finally, because the extra value that's produced in the production process is a result of this labour power and the difference between what the capitalist pays the worker and the amount of value that they create, the capitalist always tries and makes the worker work harder, okay, and for longer periods of time to get more value out of their work. So there is and this is something that is clear under neoliberalism, a tendency for harder and longer periods of work. Okay, they try and extract as much work as possible out of the worker. Okay, so there's a lot of different ideas held in here, and it is quite complicated, but I think it's important to have some kind of overview like this. But I want to just talk a little bit now before handing it over to Tom about, if we see this circuit of capital, where does credit come from? Okay, which is really like the point of this talk, is to understand where does credit, finance, how does it emerge as part of this circuit? Okay? If we look at this circuit, you see that there are different points where it can break, where something can go wrong in the process. For example, the capitalists could produce their goods here. Okay, everything works fine. They do the production process, they come to the goods. And then there is no one in the marketplace to actually buy the products. Okay, there's not enough demand in the marketplace to turn all of these C-prime, turn all of these commodities into money for the capitalist. So there is a potential break here. Okay, there's a potential break in going from C-prime to M-prime. It's possible that this doesn't happen, in which case the capitalist is in big trouble because the whole point of their production was to go from M to M-prime. And if that doesn't happen, the system itself is faulty. Another possible break. Because of this tendency, improving the productivity of labour, putting more machines into the production process, it's possible that, or it means that the amount of money that a capitalist needs to start a company, to start to be competitive in an industry, is huge. And you can see this now. If you want to enter into any industry, you need a lot of money, startup capital. Okay, you just can't go and start up your own, production of shoes. Okay, you wouldn't be competitive in the marketplace. You need a lot of capital to actually be competitive in industry. So, and this, as you go to larger and larger scale industry, like pharmaceutical industry, any kind of petrochemicals, anything like that, none of us in the room have the amount of money that would allow us to enter those industries. Okay, the reason for that is because the startup costs, the amount of machinery involved, is very, very huge. So another possible break in the system occurs here. Okay, if the capitalist can't afford, if the capitalist doesn't have the money to be able to pay for this means of production, okay, then if this breaks, then again the circuit doesn't follow through. Okay, so in practical terms, it means if the capitalist can't afford to start up, pay for the machinery and the raw materials, etc., then they're going to be in trouble. Another example you can see is here. If the capitalists can't pay the wages, okay, then, and they can't engage the labour power because they haven't yet made their money here, then there's a possible break in the system. So these possible breaks in the system were present from the beginning of capitalist production. But what it means practically, and this is that capitalism develops ways of getting around these possible breaks or discontinuities in the circuit. And the way it does that is through the development of credit. Okay? This is where credit comes from. It's not something that was invented by the capitalists. It actually arises as part of the circuit of capital, as part of the functioning of the circuit of capital. What the capitalist does is it takes money, M prime, from another part of the system, okay, or another sector or another industry that's accumulated in someone else's hands, and redirects it to stop these breaks happening. Okay, so for example, as I said, the idea that you need a lot of money as startup capital if you want to engage in any industry effectively. Okay, what does the capitalist do who wants to start a business? They go to the bank, or they go to many individual venture capitalists, or they go to different other owners of capital and say, lend me some money so I can enter this industry. I expect to make this amount of profit, blah, blah, blah. I'll pay you a little bit of interest, but just lend me this money, this credit, so I can engage in the production process. Okay? Or the capitalist says, and this is something you see a lot in small businesses, okay? Small businesses are always going to the bank in order to get credit to pay their wages, to pay payroll. Okay? So they go to the bank and say, look, we haven't yet made our production, we haven't yet sold our goods, so we go to the bank, we borrow $1 million a month, okay? We pay our workers, then hopefully we sell some more money, we pay back some of the loans, but they live on this system of debt in order to function. Okay? So one of the big problems now with the seizing up of the credit market is that small businesses have this problem of payroll. They can't get credit in order to pay for their labour power. Okay? another big problem with the seizing up of the credit markets is that capitalists can't borrow money to engage in any kind of large production. Okay? So all of these big infrastructure projects are collapsing. They can't borrow the money in order to start. Finally, this possible break here is a big part of the functioning of credit. Okay? So what happened under capitalism historically is that because capitalism has this tendency to produce more and more goods, saturate the market, they need to find ways of keeping demand up the whole time. They use credit to create this demand. Okay, so they would produce, they would basically redirect money into the hands of consumers or business in order to keep the demand up for these commodities. Okay, this is why the subprime mortgage thing happened in the first place. Okay, basically, what the capitalists tried to do was find a way to give money to ordinary consumers, and the way they decided it was go use your house as an ATM. Okay, go to the bank, take money out of your house. You can go and buy your TVs, your videos, your holidays, whatever it might be, and you keep up demand. Okay, this is where the production of the subprime mortgages, as one small example, there are many other ways. Credit card debt is another example. Okay, in order to keep demand up, people would just max out on their credit cards. Okay, is to keep this demand going. Okay, so that's another very critical part of the functioning of credit in the system. So the thing about this whole credit system, though, is that this extra money that was redirected into the circuit of capital to stop these potential breaks in the system is a claim on future value. It's a claim on value that hasn't actually been produced. Okay, it hasn't actually been produced in this way. It's kind of saying like, well, if I lend you $1 million, okay, the value of that $1 million will be realized somewhere in the future in this production process. Okay, so this is it's an important thing to remember that only labor power involved in production creates value. Okay, money as such that is lent as credit does not create value. Okay, it does not create value, and that I think is a really important part of understanding what the implications of this crisis is. I'm not going to talk about it because I think hopefully Tom and Greg will go into it in more detail. But I'll leave it there.
Great. Thank you so much, Adam. I'm glad that you did this part. I learned a lot myself. I'm going to go into more specifically the money relation relative to credit. Now again, it's going to be sort of a complicated diagram type thing. So I brought some copies here. I don't think there's enough for everybody, maybe 4 per row, and you can sort of share them. So what I want to talk about then, so what I'm going to be working on is very much sort of the expansion of money and the role that money plays in the circuit of capital, and looking specifically at the circuit of capital, beginning with money and interest-bearing capital in this regard. Now, how is this money that's being lent in the capital, how is it created, and how is it augmented? Because one of the important things that has come across in the currency crisis is that there's all this money circulated, now there's claims on these debts, and there's no way in which they can actually pay these back. So I'm not going to draw out this diagram. I'm talking specifically about this diagram here on your paper, it's the sub-circuit of bank capital. But what we're beginning to talk about is the money and interest-bearing capital. So at the beginning here, this money of capital used by both labor power and means of production. Now where does this come from? Now typically, most often, not necessarily, but this money is borrowed, as Adam was talking about. And this is the question of interest-bearing capital. Who lends the money? It's a bank, right? So I'm making shoes. I need to make these shoes. I don't have enough money. I go to the bank and I get a loan, right? So in this circuit, in terms of interest-bearing, I want to look at, first of all, deposits. So this is going to be easier to draw a little bit here. But deposits, first of all, looking at this, comes
interest-bearing?
Interest-bearing is a bank loan. So I make a loan. Thanks. Actually, this is complicated. So if you have specific questions like that, just throw it out there. So interest-bearing is you get a loan, as we all have, and you pay interest on it. So I mean that capital, in the form of money, bears interest, and it's the movement, specifically, sort of the shortened version, is from money to M prime. So the interest of finance, so we're talking here about finance and banking, is to go directly from the money they have in their deposits and reserves, directly to profits, to interest, sorry. So interest-bearing capital. They get the money that we use through your own deposits. So we all make, many of us, I'm not sure if there's capitalists here, but we're all sort of get paid wage labor, right? So this is our labor power. And in here, you see under commodity that we have the means of production plus labor power under the sort of commodity version there equals money. So this money that we're paid for our wages goes into deposits more or less in the banks. We spend it either through purchasing things or we send it and deposit it, and it becomes part of the reserves of the banks. Now, this is an important aspect of where bank money actually comes from, is the reserves. So we're making, we put $100 in the bank, and then from there, the bank is able to augment that reserves. Now, the sort of note I have at the bottom of the page is that in effect, the historical, political, social, and legal authorization to create money over and above what they have in reserves. So this is what banks are able to do. They're legally, historically, socially able to augment that $100 you put in the bank and create loans of it. So this is what we talk about in terms of the deposit base of a bank. So they can take that $100, and depending on where the bank is located in the world, we're able to augment that, say, 10 times. So they take your $100, and they're able to loan out $1,000 to begin this process here when we're talking about production. So you lend $1,000 here in order so the capital can both buy labor power and the means of production. Okay? Now, at that point, the loan, as we're looking at the diagram here, goes into the commodity, goes through the production process, and then the commodity here is C1. And at this point, in the diagram here, we go into assuming that the commodity is sold, they get their money for it. Now this is broken into three sort of sub-circuits here. Now one is the profit that Adam was talking about. That this is a surplus value that it is extracted from labor. Now it's important that this is a process of exploitation by definition. Now what Adam was talking about in terms of creating value here, you get paid less than what they actually sell the product for. That becomes profit for the capitalist. And in the diagram here, the profit goes back up into the deposits, more or less, of a bank. Not necessarily, but on average, in a sort of abstract level. All right? The second part of a loan, it goes through the circuit of capital after the profits have been taken out by capital, is the sort of M that I show there. Now this M is simply paying back the actual principal of capital. So you borrowed $1,000, you need to pay back that $1,000 to one extent. So that M, the line goes back to, I'm going to put reserves over here. Okay? So that money goes back to the bank into its reserves. And I'm going to explain that in a second a little more. Now the third aspect of that money is the actual interest payment. So this is the money that the banks make on their money. They're looking this is their reason to be. They're compelled to make money just as capitalists are. And so you're paying back the cost of money. This is your premium. You borrow $1,000, 10%, you have to pay back $1,100. So this also goes back into reserves of the banks in that sense. Now, between the deposits of banks that add to the reserves and the actual reserves, now these are sort of two, there's part of a similar pool of money that a bank will have, and CIBC will have, right? They have this $1,000 of your deposit, right, from you working, putting money away or whatever, or through purchasing things and capital deposit money. And then they're going to have the reserves from both the money and the interest that is paid back from the loans that go through this process of capital, okay? From both these deposits, well, when you add the deposits to reserves, that's where you create the money to go into interest-bearing capital, okay? The importance of the two, between the deposits and reserves. Now, deposits carry with them an obligation to repay. So you can go to your bank and withdraw that $1,000 if you want, to some extent. You have that right. Now, banks, when you get, they call these run-on banks, that means everybody's going back and trying to pull out their money. I want my $1,000, you want your $1,000. Everybody wants their $1,000 at this point. But because they can loan over and above your deposit, say 10 times, they're only keeping $1,000 in bank, but they've lent out 10,000. So now, if you try to recall your money, they're not going to actually have it. If 10 people come back to get their $1,000, they only have $1,000. So this creates a problem within the bank, and this is your classic run on the banks. They simply don't have the money in the vaults to give to you. This is a normal process of capitalist money creation. Insofar as you deposit your money, they augment it 10 times. They don't keep your money in the bank. They pay you a rate of interest, say 2%. They loan that money out at 5%, and they're making money from the M to the M1 on that difference. That money is created, the value, the interest, is going to be part of the production process. Okay? And they're creating, they're hoping that whatever is made here, the money lent out in the production process, is actually sold so that this money can then come back into the reserves. So these are, yeah.
Does that include credit unions as well?
I don't know specifically about credit unions, but yes. Any bank is going to be augmenting money. This is a social and a political reality. This is an important point. It's actually not it's a technical feature, but this is a social relationship that we have grown into. It's not necessarily natural, but it's evolved over time. These have not always existed. Banks have not always been able to augment the value of their savings. So these deposits, there's some rules around it, right? 10% reserves, the Basel Accords, these sorts of things. And it varies from advanced industrialized countries, to the amount that they can keep, to sort of weaker banks or ones in the third world. There's different rules at times for different banks. So these say you need to keep a deposit, say 10%. Reserves are a little bit different, okay? This money that's come back through the interest payment and the money, the sort of amortization of the loan, right, paying it off. So when you pay back your housing mortgage, the money comes back. It goes into reserves of a bank. So it's not a deposit that carries with an obligation to pay it back. I can't go and ask to withdraw the amortization of my loan, right? It's theirs. It's called a liberated value, all right? It's been freed of any obligations. And so these, to some extent, are more powerful reserves. They can augment that even more in terms of creating money, interest-bearing capital, to go into the production process. And they're obviously going to use the reserves, the money they make, the interest to pay their employees. They're going to use it to build new branches, these sorts of things. It is the bank's return on capital, more or less. But they can also lend more money with it in that sense. Now, I want to make a couple of distinctions here because they're important to sort of notice. So there are both banks and then there's non-bank financial institutions. Now we know about these because they're creating a lot of the problems right now. The insurance companies are the sort of more market-based non-bank institutions. There are the pension funds. There are these other various sort of market-based institutions where you can't go put a deposit in and withdraw your money. Now, a bank is special because it is given the right, more or less, social right to augment our savings and then lend out 10, 20, 30 times more than what they actually have in their reserves. Market-based institutions are particular because they collect our money, but they can't necessarily augment it on themselves. They just need to pool it. So your pensions, they take all your money from everybody in this room, and they start collecting more and more and more. And they just create a pool of that money. And then they lend out from that. So they can't augment it. They can't increase it 10 times. This is what's particular about a bank. Now, Greg's going to talk about the sort of development of these over the 1970s, 80s, and 90s, and that there's more of a merger between banking and market-based finance, so you get the connection of these two. But it's important to distinguish banks have the capacity to increase the value of the money. And they mobilize existing money savings, your existing money you put in the bank, and then augment the supply of money capital. This is vital to the development of capitalism that Adam was talking about, and its ability to move money quicker, more money. It's vital to the increase in the size of the production process, to the concentration and centralization of capital. So the other important point, and Adam touched on this, is the issue of fictitious capital. Now, the money that is created here, you have your $1,000 that's been put into your deposits. This is money that's been created and been realized, as Adam said. It's been sold, your labor power has been paid off, the money's back in the deposits, right? And so to some extent that liberates it from its initial augmentation. But this money that's flowing through here, not the $1,000, but the $10,000 that is lent, as Adam said, is fictitious. It's betting that through the continuation of the labor process of selling M1, of selling the shoes that you make for profit, that you're going to be able to pay this back. Obviously, if you're getting credit, you don't have the money, right? So it's fictitious that they're creating it. Now, again, assuming that these products are sold, the value realized in the monetary form is M1, the surplus value. This process validates the bank's original act of money creation. Okay. Now, I want to touch quickly. What time is it here? 1:30. Okay, so some time. I want to touch now. On the. I'm going to go to the internationalization of capital, or the speculative, talk to the next page, the speculative capital here. This is, I'm going to talk about it, and hopefully you can see on the direction next to it. Okay, so as you're entering into, as capitalism has this competitive pressure where people are compelled to profit or die, essentially. If I make shoes and I can't make money, I'm going to go out of business. It's an objective social relationship of this, right? The same is to some extent true of banks and financial institutions. If you're not making money, you're going to go out of business. Now, just as in production, and I focus more on the financial aspect, where you're compelled to sort of raise the productivity of labor, decrease your means of production, things like that, so too are financial capitalists compelled to decrease costs. So you'll see in banks, you'll see the centralization of banking capital. So that means the pulling together of many different institutions. So whereas, a country, whereas, say, Mexico had 90 different banks in the mid-'80s, they have 5 or 6 dominant banks now. So they pulled together all these different banks, centralized their operations, and concentrated all of that capital. That allows them to profit more on the one hand, and allows them to increase the velocity of capital going through the system. Now, the problem is that, again, as Adam was talking about, and the second one here, we have the speculative capital. So from interest-bearing, these banks are trying to lend out money based on their reserves, right? So they have 10%, and they're making loans to the capital. Now, because they have these same competitive pressures, CIBC needs to profit as well. But if they're making loans, they're held to keeping those reserves at 10%, right? So how do you increase your profit? How do you increase the velocity of money? How do you get more money flowing through the system? How do you create more effective demand? Well, you get rid of those loans. You try to package them up, put them at different varying levels of risk, and then you sell them to, on the diagram, again, sorry. So money, to speculative money. This is interest-bearing money, this is speculative money capital, okay? So people are gonna bet on whether or not you are gonna be able to pay back these loans or not. Now, I'm gonna go through a couple of technical definitions here of some of the terms that you're gonna see in the media that are quite common, and just give you sort of bourgeois definitions of them, which are important, and then we can sort of locate that in a more social context. So now the increase in speculative capital has really sort of come on board since the 1970s, mid-1970s, and there's been a very rapid development of various instruments. So these are new techniques that have been aided by information technologies that have allowed financial capital, banks, speculators, to quote-unquote better evaluate and separate, calculate volatility, and essentially trade in risk, sort of so-called risk management. So the banks, interest-bearing capital, puts together their mortgages. Some are subprime, some are not. They might be all subprime. And then they sell them to investors who want to they're trying to get rid of some of these obligations to increase their reserves to make more loans and just take a cut of it, a premium of it. And then other people are trying to assume that risk so they can make money off of that on pure money dealing, okay? So one thing that I speak about it in terms of the derivatives are options and futures. And these have become greater use since the 1970s. Now futures have been something that are around for a long time. Future is you grow grain, you're not, you want to make a contract that you're going to have, sell something in the future at a certain price. You want to guarantee that, if I'm a farmer and I want to grow this stuff, then I'm going to be able to sell it. So future contract is locking people into buying or selling assets at some point in the future. So this is one kind of contract. Options that have also been developed since the 1970s act more like insurance. So insofar as people pay a premium, so you're going to have your grain, and you're going to pay a premium, like an extra additional fee, to use this option to buy if prices move in a certain direction. Otherwise, the option lapses, and then you just pay the premium. So you have an option to buy the grain. The future is a contract to buy it. An option, like it says, you can decide whether you want to do it, but you pay a little bit extra for this, right? And it's an actual contract to buy the grain. So there you get buying and selling, speculative buying and selling of these contracts. Some people want to hedge against the risk, meaning want to lay off the risk. They don't want to deal with this. They've got this contract for the grain. They bought it. They need some money, so maybe they're going to sell it to person B, who thinks the price of grain is going to go up or down, betting on the price. Right? Now another sort of instrument that has arisen are called swaps. I've got a few of my speaking notes here that I can give at the end if people want, though. I just didn't want to hand them out now. So swaps worked originally through trading in bonds, so sort of money contracts in one currency or another, and you essentially trade them off. So you might buy a bond in one country, somebody else have a bond in another country, and you want to swap them to sort of bet or work on interest rates in either country. Now these, again, are political tools or instruments, and these are historically, rules have changed to allow this. It isn't a natural condition. And as Adam's pointing out, these have developed in the context of capitalism to allow the flow of money to go more rapidly, to allow risk to be traded, and to allow people to, if you're needing more money to pay off, your labor power or something like that, to get rid of some of the obligations that you have. All right? So these are instruments, and they're political, that have risen in the last 20, 30 years. So swaps work through trading in bonds, issuing one currency and swapping them for another bond, creating lower interest rates for both borrowers through the potential for currency arbitrage. So trying to bet on the value of currencies and interest rates, and you make money off of them or lay off risk. Now, this original swaps have led to more recent, or led to a second technical tool called interest rate swaps, where borrowers with variable rates. Now, if you have a mortgage, everybody knows about variable and fixed rates right now, because if you have a variable one, you're like, great, the interest rate is falling. If you have a fixed rate, your interest rate is stuck a little bit higher, right? So the interest rate swaps are allowing variable rates to be traded for fixed rates. So again, if you have too much risk, too much money you build in on this variable, maybe you want to set it at a fixed rate and you trade your contracts with people. Movements of speculative money and capital. Okay? Now, this is where it becomes more interesting in the last 10 years, and this is really leading to where we are today. Right? We're leading to these contracts, trying to free up money. You can make your trades, your swaps, and as Greenbank said, this is all supposed to be in your self-interest. Right? You do this to preserve yourself. You would never do this in a way that would destroy your company, destroy your financial balance, these sort of things. So self-interest is supposed to ensure your security. So it's best to create these instruments to be able to trade and risk as you want. Speculative money and is at the beginning of the circuit of capital, right? So in the last 20 years, we've been hearing now about credit default swaps. Now this financial instrument enables people to separate the risk of interest rate movements, so if they're going up and down, out from the risk of a borrower who may not pay the default. All right? So again, you're betting on somebody's financial collapse. Whether you think they will or will not be able to pay back. Let me reread that. This instrument enables people to separate the risk of interest rate movements out from the risk of the borrower. So are they high risk or low risk? For a price of capital, a premium, one person, one party to a credit default swap will insure against any default. So these CDSs, credit default swaps, have exploded in the last decade. According to the economists, they've gone from nearly zero value and not being used 10 years, not even 10 years ago, 2001, to having a value, a market value, of over 60 trillion US dollars today. So this is the creation of massive flows of risk being traded off. Is this person going to pay back? I'm going to bet on it. I think they will, so I'm going to buy that from you. And then, I'll carry that package and hope they'll pay off, right? Yeah, so essentially, through these credit default swaps, people are betting on another person's financial ruin. Now, with any of these financial instruments, futures, swaps, options, there's a small initial position. So you sort of put a deposit, a small little bit of money on the initial instrument, the initial financial instrument, right? But you take on the full brunt of the obligation. So it's very similar to reserves in a sense. The banks are making a loan at 10%, you buy a swap or an option, you put a small deposit, you're taking on the full brunt of that obligation. So it might be $1,000 down, but the obligation might be worth $10,000, right? So you've seen the augmentation of money in that sense. Now, a small initial position can ultimately result in massive exposure, I would say, especially in times of systemic failure. So, as Adam was pointing out, if there's a break between the production of the shoe and its sale, then there's going to be problems. If you bought an option to buy these 10,000 shoes, right, and you can't sell them, then your initial, the money you put down, you can't get your money out of it. You've taken on this risk, but you can't actually realize anything because nobody's buying shoes or nobody's buying grain, right? Or not at the price that you hope they would, for that matter, right? So, where was I here? So then, with these sort of trades in risk and speculation, the net exposure might be smaller, but the overall position can be enormous, which leads to a problem if one counterpart defaults. Now, the overall result of these complex and overlapping obligations, many people, these are contracts that one person owns, everybody's betting on similar contracts in the movement of. These often overlapping commitments that regulators have a difficult time actually assessing. Time?
Well,
wrap it up? Yep.
Yeah.
Okay. Right. Okay. So the problem is that when you see these trades and speculation, these swaps, these initial positions, the regulators don't actually have an idea. And they're relying, as Greenspan says, on your innate self-interest to regulate yourself. Now this has collapsed, obviously, in the last little while. So, and the way, again, the basis of the crisis, securitization. This is it's at the heart of the current crisis, which means that the bundling of loans into packages are then sold to other investors, and the U.S. was the first market that really got serious about that. Now the homeowners make payments on these loans. They're collected by a servicing agent and then passed on to the investors as interest payments on their bonds. So this is why people are speculating. Right? They buy these loans, They pay a premium on them, but then they're just hoping that you'll keep on making your payments, and that's how they make money on it. Right? From 1995 to present, U.S.-backed securities grew more than fivefold. So about 300 million to over 2.5 trillion dollars presently. So this is within the last 10 years, more or less. Let me see, where can I go? Yeah, essentially this allows banks, the important point that I guess you want to focus on, is that the securitization, and why these are important, is it allows banks to take those loans that they've made to you. Take CIBC, can take your home mortgage, put it together, and get rid of that risk, and then again augment their loans that they're giving you. So not only are the reserves, your $1,000 in it, augmented 10 times, but then they take that loan that they've made with your reserves, sold it off, hoping you'll pay it back. That's released their obligation, so they can take that same money and do it again to another person. Package those loans, sell it off to another investor, take that money and do it again. This is why nobody knows the real extent of this crisis and how deep it goes in terms of the financial depth of it. 3 final points. People who control these flows of funds, so people control these M interest-bearing, M speculative, neither own the banks entirely concerned, nor all of the funds being used. So they're playing with your money essentially, but they exercise control over them. More capital is concentrated in these financial institutions, and control is more centralized in fewer institutions, and this leads to more intense competitive pressures and social control over the production process. So the control of money at the beginning influences everything that follows: labor, power, means of production. This is important to a Marxian analysis. It's a social relationship. Now, money has obviously become more determinant in the economy, production, state finances, and our everyday lives. Working classes are being forced to bear the costs associated with this risk of financial accumulation through the socialization of the risk. So we're picking up the bill for the $700 billion, in the U.S. I mean, not we are, but in Canada, everywhere in the world, it's going to be your taxes that are going to be picking it up. But at the same time, we're paying for this through rising service fees, charges, services, and bank services, and access to loans that are far from guaranteed. This is a social and political process that is rooted in class and the extraction of surplus value that I was talking about. And it's a highly disciplinary process that everyone must respond to the imperatives of this finance. There's very little choice but to do something about this financial crisis. Okay? Thank you. The question about the bank insurance, the bank insurance schemes, it's an important one because to some extent it underlines, it's a major debate within Marxian theory, what actually backs money. And we need to begin with the fact that money, like production, like commodities, like the market, are all social relationships. And the money you hold in your pocket is the money that you earned, less the cut of surplus value. Right? So when you get the runs on the banks and why the governments have, and I think actually, Greg, I'm not sure if you'll speak to this in more depth, but they want to insure them so that systemic panic doesn't sort of overflow the system. Right? Now this is based, again, on government guarantee, and it directly links to the question of fictitious capital. Essentially, governments are guaranteeing the future value of your deposits. And if something happens, essentially, they're linking that to you working in the future, right? Because you will have to actually pay for it. In some sense, they might not lose money. They might not, they're going to guarantee it, but they're guaranteeing it on your labor. Because the governments are paid through tax revenues, these sorts of things. So it's a foreign fictitious value. And it's based on the capacity of a country to create that value in the future. Who knows what the limit of it is? Like, this is uncharted territory. Like, the hundreds of billions of trillions of dollars that have been thrown into the system have done very little. And most of it, it's all back on your capacity to produce. So there's no real answer. It might all come crumbling down. It might renew, another might be a bourgeois revolution in that sense, insofar as they figure out a way to fix it, and it might continue on some sort of a new deal. Who knows? It's a political question, not a technical, economic one, purely economic one. Do you want to take
Okay.
if there's something else later.
Okay, so I'll take us up to three of them. Firstly, on the question, Herman's question about realization, the final step here. It wasn't just consumer. It's not just a matter of consumer goods and the putting purchasing power in the hands of consumers through credit card debt and mortgages, etc., etc. But also through the growth of state debt and state functions in the post-war period. Guarantee of corporate profits through the action of the state, which is where Keynesianism came from, essentially. So governments would say, this costs a lot of money to engage in this production process. The government will come along and say, we will invest, millions of dollars in building this factory, okay, or building this production process, and it's a way of channeling funds in guaranteeing the profits of individual capitalists and guaranteeing demand. So another source of demand is the military industry as well. Okay, is a big part of this as well. So the growth, this realization question, it's important not to see it just in terms of the consumer, but also the critical role of the state in the last 40, 50 years in guaranteeing these capitalist profits. But the question is, what is the limit to that? But also, over the last 10 years, the American consumer has really become the key question in this particular step. Okay, so the whole housing bubble was really around making the American consumer, on a global scale, this point, this source of realization. Okay, previously it had happened in the third world, with the third world debt. It had happened in Asia with the Asian crisis in the late 90s. This extension of debt. But the real growth in consumer indebtedness happened in the last few years with the American consumer. So this is why the crisis is so critical, because if the American consumer drops, the whole globe drops. Okay, it's such an interconnected system now. This circuit is so globalized that if there is a break here, it actually affects everyone. But we can talk, I'm sure we'll have much more time to talk about this later on. On the labour theory of value, I think it's important not to try and say, okay, what does this particular job create value? I think that's a kind of a misconception of how people see the labour theory of value. It's important to see value is a social relation. It's created in this relation here, okay, between the worker and the capitalist. So that's the thing that you have to see. If you are producing a commodity, something that is for sale within a capitalist relationship that goes to the marketplace, and it is a commodity that is bought and sold on the marketplace, that is a value-creating thing. Okay, so particular jobs, some of the tasks in the job might be value-creating, and some of the tasks might not be value-creating of a particular individual in a particular job. But if you contrast it with, I think one way of thinking about it is there are some activities that create value, and there are other activities that merely swap who owns that value. Okay, merely swap titles to the value. So advertising, okay, what does advertising do? It doesn't create value. Advertising just determines which capitalist actually owns the value, okay, or appropriates the value. Finance doesn't, in my opinion, create value. Okay, it just determines which capitalists or how much each capitalist get of the value that is being produced. Okay, it's swapping titles to the value that's being created. So yeah, some parts of the service industry I think are value creating, some parts aren't. It just depends. Is it producing a commodity that's bought and sold? Is it something that is actually just a title over the value that's produced? It's complicated and there's a big debate about it, but I do think the fundamental point is really true and is very important to understand, because one of the conclusions, if you have that viewpoint, is that in the value-producing sector of the economy, the rate of profit will tend to decline over the long term. And I think this is one of the reasons why there's a growth in the finance sector, is that capitalists have switched out of, or in search of a higher rate of profit, have left the production sector and gone into finance, where there are much higher rates of profit. Okay, so in the if you look at U.S. Corporate profits in 1980, finance was only 10% of corporate profits. By 2007, that had risen to 40%. Okay, the rate of profit that you were getting as the owner of a hedge fund, is hundreds of percent. But if you're just in basic industry, you might be only getting 2 or 3%. Okay, so this is one reason why there is a bubble. Like, people have switched their investment over to the finance sector. And just on Art's point, I think, I mean, there's a lot of people who have written around this stuff. I think Ernest Mandel is really had a lot of stuff to say about this, and also David Harvey more recently. And David Harvey's lectures are actually on YouTube, which are really useful.
Do we have any? I just wanted to comment. I think some of the questions on the questions of labor and what are workers, we'll deal with that in the last session today. So we'll sort of hold on to those questions, and we'll deal with them later. In regards to bank nationalization and the P3s, I think this is important. Again, maybe we can discuss in terms of alternatives. But I think an important issue to be noted is that ownership does not determine the sort of the direction of where money goes. So even though the government owns a bank, whether it's the U.S. government, doesn't mean it's socialist, doesn't mean it's progressive, doesn't mean that the money is going to be going to the people in any sense. So let's push that question to the last one, but it's underlying that it's a social and political determination of that in some regards. So yeah, I think we better.
I'll take it up also with it in the next thing.
Yeah.
Or in the next one.
Okay. Great.
Yeah.